Well, good morning and welcome to today's ASNA Edge marketing meeting. We are so glad to have you with us today, and Merry Christmas, and we wish you a very happy new year coming up. We have so much to bring to you today. We have Sterling Smith, who is our Director of Ag Research. He is in the green, and in the red, we have Mike Toohill, who is our corporate agronomist. And we are going to talk to you today about all things that you need to know coming into this 2022 crop year. We don't have Brooks with us today. He is at a farmer meeting right now. He's probably tuning in, but we just want to let you know that we are here to serve you. Our team provides all the things that you can see on the screen right now. We bring together market analysis and show how that works with your crop insurance policy, that you can have the best risk management plan overall. I want to go ahead, and if I can get this to work quickly here, I'm going to change so that I can pass this right on over to Sterling so that he can get started. He has some great things to share with you. There were some big reports that came out this week. The Fed had some good reports. Well, maybe not good. They've decided they're going to increase our rates, didn't they, Sterling?
Yes, Federal Reserve had their December meeting yesterday. They did leave short-term interest rates unchanged, which was as expected. Now, there's been a lot of tension about where interest rates are going in vis-a-vis inflation. I will give Mr. Powell a lot of credit yesterday. He was very polished in his remarks. He was very clear, and the market, particularly the equity markets, took comfort in that. Now, we have to look at the other side of the coin. What he told us, most likely the Fed is going to be looking at raising interest rates three times next year. So that is a change from what the conversation was. They have taken out the word, removed the word transitory when they start talking about inflation. Now, inflation is a weird and squiggly thing. It's kind of like, if you remember the Rocky movie, where Rocky is chasing the chicken around the barnyard and he says he feels like a Kentucky Fried Idiot. If you don't take inflation and keep it under control, the Federal Reserve will look like Rocky chasing that chicken around. It can be very hard to catch. So lower interest rates tend to prompt more inflation. We also have a thing called quantitative easing that's going on, and you hear the word tapering. They're planning on finishing their asset purchases now in March. What this means is the Federal Reserve has been going in and they've been buying government bonds, they've been buying municipal bonds, they have been buying corporate bonds. They do this to keep interest rates under control. That keeps things, when you have the Fed with a balance sheet that can take on basically anything onto it, this pushes interest rates lower. That means it's cheaper for businesses to borrow, cheaper for corporations to borrow, and cheaper for governments to borrow. When they stop doing this, interest rates are going to tend to move back to where they reach a market clearing price. Now, we're going to take a look right now here. I'm going to go ahead and we'll just start talking about, we'll just talk about interest rates before we talk about weather. And I'm going to put up a chart of 10-year interest rates. If you want to go ahead here, I'll switch. So, Christy, are we seeing this?
Here we are.
There we go. As you can see right now, rates on the 10-year are sitting at 141.19. They didn't really move with yesterday's Fed response. They also didn't move with some inflation numbers I'm going to talk about that we saw on Tuesday. But if we go back, and I'm going to make this chart go back further and further over time, as we can see, interest rates have been generally going down. Pre-pandemic, and if we go back to 2018, they peaked at right around 3.25%. And they started actually moving lower in 2019. The Fed did cut interest rates as the economy was showing some signs of some problems. We saw high energy prices and things slowing down, but we didn't see any inflation. Now, the Fed, it's kind of like, you know, if the only tool you have is a hammer, everything looks like a nail. The Fed has a lot of tools, but at the end of the day, the only tool they really have is to raise interest rates. And what happens then, investors will be more inclined to buy a bond that will pay 3% more than they will buying 1.5%. And you think about that, well, the difference between 1.5% and 3% isn't that much. But the reason they buy those is because when we reach the end of that hiking cycle, the Fed cuts interest rates and interest rates go down. Now what happens to the value of those bonds? It goes up. So when people buy bonds at interest rates at lower levels, they don't buy them for the yield. They buy them eventually for price appreciation. By the same token, if we think interest rates are going up, you're not going to be a bond buyer because you're not going to want to buy a bond that pays 141 and then have interest rates go up to 3% because one, you're only getting paid 141 and the value of that bond drops. So we're creating a situation where we could see interest rates move up noticeably and meaningfully. And what I think is interesting here is the fact that interest rates are actually lower than what we saw them a week ago. And this is different. And this is a little bit troubling because it's not playing according to the handbook or according to expectations. And if we were to see a spike in interest rates, that can lead to a lot of other less than comfortable things, particularly for things like equity markets. Higher interest rates are also toxic to commodity markets. What happens when interest rates go up? The dollar index goes up, the value of the dollar goes up, and commodities find natural market clearing prices. As much as the Fed likes to try and push things, the market goes where supply and demand will take them with commodities because they're simply too hard to push around for very long. So we could be looking at a situation where if we see a rising dollar and rising interest rates, this could be a bit of a problem, particularly for commodity markets. And if we take a look here at our friend the stock market, this is actually a little bit more troubling than it seems. Yes, we traded and touched near a new record high this morning. But as you can see, this is the last time we made a record high, the market collapsed. Looking at action today, here's yesterday's action with the report, and the market felt very good. And again, I don't think they felt good about the content. I think they felt good about Mr. Powell and left the idea that he had his arms around this. But today, as you can see, the market opened at a record high. Guess what? It's falling. Oh, that is, if you're a trader, that is the most troubling thing you can ever see, is a market that opens higher and starts to work lower. Healthy markets start the day weak and finish the day strong. Markets that have issues start the day strong and tend to finish the day weaker. So the price action on this today is going to be something that people are going to be watching. And again, if we have problems with the equity market, that tends to lead hedge funds and other investor types go into what we call a risk-off mode, where they pull in all their money, and it may be corn, it may be soybeans, it could be gold or crude oil, but that ends up taking support out of the market because of uncertainty, and that can lead to lower prices. So right now we have a very, while things behaved well yesterday, there weren't any surprises. And that is something that the market will have a problem with. Now, we had some inflation numbers this week, and we're going to take a look here at the finished goods. Inflation, oh, that's not the one I wanted to show you. Yeah, let's see. Let's go ahead here. This is the producer price index. This is what companies who make things have to pay for stuff. And guess what? When these prices go up, that leads to one of two things can happen. One, if the company has pricing power, they will raise prices on the consumer. That's the definition of inflation. Two, if they don't have pricing power, the companies themselves have to absorb this. So they absorb the higher prices, and that leads to lower margins. And with that, that brings along a host of economic problems. Now, this year-over-year rate for the finished goods came in at 13.3%, which we had CPI last week, and it came in at 6.8%. But what people who produce things, they're having to pay a noticeably higher rate, and it doesn't show any signs of stopping. And this means that there can be more inflation coming in for the consumer. And if we look at this, this is the highest we've seen this number. Now, we have to go back to the Carter years. And for those of you on the call who remember it, I was only 10, 12, 14 at the time. So what I noticed was two things. The candy bar got more expensive and it was getting smaller at the same time. And this is now starting to move into some uncharted territory here where things can get a little bit nervous. So what does that mean for commodity markets? And we're going to switch screens here real quick. And actually, are we going to switch screens? We should be able to switch screens here. Okay. Okay, are we all seeing chart of wheat here? Okay. Is that what you're seeing there, Christy?
I believe so. Yes.
Okay. So we're going to switch that. We're going to change this over to corn, and we're going to look at the price of December corn futures. Actually, we're going to look at the price of corn futures going way, way back in time here. So this is a picture of corn prices for front month corn. Biggest period of inflation we saw started really in 1973, and it ended in 1980 when interest rates started moving up astronomically. I was talking about interest rates being 1.4 on a 10-year. Where they were back then, can you say 17%? So obviously a much different interest rate environment. But this is a chart of corn during the period of the greatest inflation that we've seen in modern times. Corn prices started this period, $3.97 a bushel was the high. During this period of inflation, what did corn prices do? They did not go up. They bottomed at $1.84, and then they started to pick up, and we had a number of things, and this is grain embargoes and things, but prices did manage to recover a little bit, but they didn't even go back to the old high. Now think about this. Corn prices were $3.97 a bushel in 1974. Corn prices, their average price, I'm going to show you the average corn price from 2016 to right now, to 2021. This is the average front month price for corn here. As you can see, for most of it, we're hovering right around $3, and then we had this nice spike up here. I mean, you have to go back to 2012 to see any big prices. So even though we had 40 years, roughly, of inflation, corn prices did not move up with them. So we cannot count on seeing consumer inflation numbers push commodity prices higher. That is a misnomer. That is a myth. There is absolutely no factual basis for this. Commodity prices, when they go up, they can lead to inflation on the consumer end, but it doesn't necessarily mean inflation on the consumer end will create inflation for commodity prices. The reason for that is when you look at that loaf of bread in the grocery store, there's a lot of things that go above and beyond the wheat to put that loaf of bread on that grocery store shelf. Labor at the grocery store, energy costs to move it, processing costs, packaging costs, all of that. You can have inflation on that without that one bit affecting grain prices. And we need to keep that in mind. And we can't take any comfort in the idea that we're going to see inflation work to push prices higher. Now we're going to take a look here and what we can expect a little bit for old crop corn. Put up a chart of this here, and as you can see, corn prices have been very stable. The market has been very, very quiet. We really can't go below much $5.50. We can't really go above $6. Demand for corn has been very good. Ethanol grind numbers have been pretty good. Exports so far have been in line with expectations. Now, these expectations are starting to back off a little bit. We had a really good sale to Mexico, and we're going to have, when I put out my report this afternoon, that's going to be really good. But Mexico comes in the second week of December every year, and they buy a whole lot of corn, and they buy some for next year. What we haven't seen is China coming in here and buying. And that is going to make the marginal difference whether we have a great year for exports or if we have a remarkably ordinary year. And so far, we haven't seen much inclination for them to buy. But when they come in and buy, they're a lot like Mexico. They come in and they make one or two big purchases, and that will move the market. If we don't see those purchases, that is going to create a problem for the corn market going forward. Because, the next slide I'm going to show you is South American weather. Or would you rather me talk about soybeans?
Soybeans.
Want me to talk about soybeans? We'll talk about soybeans. Actually, we need to talk about one other thing with corn first. So here, if we take a look here at December corn, this is for new crop. Prices are at $5.43 a bushel. As I mentioned, the average price for December futures over the last 5 years has been $4.08 a bushel. So right now we are trading a solid $1.35 above that. If we see a change in supply, which is the thing that's going to drive price, if we see more supply and China not in here buying as much U.S. corn, these prices can start to get heavy. Now, moving on to our friends, the soybeans. We look at old crop soybeans. Right now, this is the stuff we just harvested. Looks a lot like the corn market. As you can see, prices have been very, very stable. We have seen good Chinese buying. Exports for soybeans have actually been pretty good. There aren't any issues here yet. But corn and soybeans are interdependent. If we have weak corn prices, that can lead to weak soybean prices and vice versa. So once again, we need to think about where we are with this and looking forward to next year here when we take a look at November soybeans. $12.48 a bushel, and we're doing just fine. So prices right now for that new crop are pretty good, and we need to keep this in mind, because the next thing I'm going to show you here is the average price for November soybeans over the last 5 years. And as you can see, here, let me get my this. See, the average price for November soybeans for the last 5 years is $10.10 a bushel. So we're trading $2.38 above what the typical price is. If we see good production out of South America and we avoid problems in the U.S., a mean reversion would indicate that we might very easily take these below $11. We might even take them to where they trade in a range of 10 to 11 if we don't have any problems. One of the things that's been supporting soybeans, we've seen real good soybean meal exports, and we've seen very, very good crush activity because we have seen this, very much elevated crush margins. So soybean processors have been quite excited to process beans. As you can see, we got up to $2 a bushel. Normally, if we can trade above about 85 on a board crush, the processors are happy. But notice, this has been coming down. And that's indicative of the market getting satisfied with this. And there's enough meal going around and all this wackiness with the soybean oil that these crush margins are coming down. And when they're not making as much money, they're not going to be as aggressive about crushing. And two, we know they were going to town and producing as much oil and meal as they could possibly produce when we saw these margins being good. So with that, let's talk about some weather here. Let's go ahead and switch this screen out. Actually, we'll just go right to the page here. That'll be easier. So what I'm going to show you here is how things are looking in Brazil and Argentina right now.
Before you start, I just want to put a note out there real quick. If anybody has any questions, please be sure to put those in that chat box. We'd love to answer those for you. Sterling has put out a lot of really great information so far. I mean, I've written down a lot of questions that I'm not going to ask right now.
Well, Christy, if you have questions, feel free to ask.
Mhm.
Well, I just think this inflation thing is really interesting about how, to me, it's just really interesting how commodity prices, when you look at the price of corn in 73 and the price of corn now, how that price has just not changed. I am blown away at that. Where you look at the price of a candy bar, the price of that has changed from what it was in 73 to where it is now. I just, that is amazing to me.
Well,
But if you
yeah.
guys have questions, please put those in the chat box, because I think Sterling will really, he will explain that to you, and you want to hear his explanation. He will really explain that to you. You want to hear his explanations, trust me.
And the reason those grain prices haven't really gone up is, I want to give a lot of credit to the American farmer, a lot of credit to the South American farmer.
Mhm.
Get better at doing it every year. So when you have better technology, that technology is anti-inflation. When you increase productivity, that stops price. Because the cure for high prices is high prices, and when prices go up, you invent better ways to do things. And also, Brazil. Brazil's going to produce this year probably 117 million tons of corn and 140 odd million tons of soybeans. Million tons. If we go back just to the year 2000, they were barely producing 25 million tons. So they have increased their production manifestly, and they still have room to increase that. And when they increase that production, grain prices are the most global of all prices. And when we see that, that's something that creates a wall, and it becomes more difficult for prices to go up because we can produce each marginal bushel a little bit cheaper. The good news is there's plenty of demand. So that's the good side of the equation. Now, these are greenness maps. What these do, these take satellite imagery and they look at how green things are in the growing area. And if we look here, this is our deviation from normal. This is our deviation from last year. The growing areas in Brazil, Mato Grosso, down through here all the way down to Rio Grande do Sul. And as you can see, compared to last year, we're doing much better. Compared to normal, the further south you go, there's some problems. There's been ongoing dryness. And this is something where for soybeans, it's less of a problem, but for that first crop corn down there, that may be an issue. Now, Brazil's crops, they produce two. As they're taking those soybeans out, they're right behind it, planting the corn right behind it, almost simultaneously in some cases. So how the weather behaves for the second crop of corn is going to determine how big that crop is. Last year, we all got a lot of help from Brazil and their soybeans. We saw production about 86 million tons. This year, they're going to produce 117 million if everything goes according to plan. So if you think about it, 86 from 117, that's 31 million more tons. That is a lot of corn, and almost all of that corn can be exported. So that once confidence builds with that, we're going to see, the potential for some non-Chinese purchases. We're going to see potential for prices to go down. Now, when we move into Argentina, the map looks a little bit different. Now, I've been doing this for, 30 odd years or something. I constantly hear complaints about Argentina being dry. Argentina was producing 50 million tons of beans and 50 million tons of corn, and they haven't really seen the growth that we've seen in Brazil. They haven't been able to increase their yields that much. They haven't really been able to increase production. They also don't have the land that Brazil has that they can bring into production. So Argentina kind of takes the back seat here. But we do see some dryness in and around in Argentina, and this could be bad for their soybean production, which in turn will be good for the U.S., particularly if crush margins stay strong, because Argentina, a lot of their soybeans they produce, they actually crush in country, and that becomes soybean meal and soybean oil that gets shipped into Europe. So that's something where we could see the potential for things to improve a little bit. Now, talking about crop year weather for this year, we are in the midst of a very strong La Nina. Here in Omaha, it was 71 degrees yesterday. That is the highest recorded temperature in the month of December ever in the city of Omaha. We also had a tornado, and this morning it's 28 degrees outside. But the thing that really gets me is how remarkably dry it is. We have burn warnings all over. We have dew points that are very often in the single digits. And it is the next 2 weeks, the highest chance of precipitation. One day there's a 4% chance of precipitation. And I don't see that really changing over the next 4 weeks. Does that mean we're going to have trouble this spring? No, it doesn't. It's no assurance of that at all. But dry weather begets dry weather. Moisture begets moisture. So again, everyone wants to pull out the 2012 banner. It's too early for that. But we certainly aren't seeing what we should see, and the weather is certainly behaving in a manner that I would strike as remarkably abnormal. And with that, what would you like to talk about, Mike? Or do we have any questions?
We haven't had any questions come in just yet. Let me just do a real quick scan here just to make sure I'm not missing anything. I'll go ahead and pass the ball over to Mike. I know y'all laugh when we say we're passing the ball, but that's really what it looks like, or it used to look like anyway. So Mike, it is in your court, and besides the sports people here, so we kind of like saying that kind of stuff.
All right.
So Mike, it is.
Still there, Christy?
Yep. I do want to say somebody did respond.
Mhm.
We've had we asked what the weather was like in different areas.
Mhm.
Some people saying it's abnormally wet and warm. That's in West Central Indiana. And somebody else has said that it's crazy warm and light showers this morning. So there you go. Thank you, guys.
All right. Thanks, Christy. I guess I'll get rolling here a little bit. What we're going to talk about today, I'm going to talk about this crazy U.S. weather. Sterling alluded to that here. We were kind of lucky here at Bloomington, Illinois yesterday. We had clouds all day. We only got up to 63, which is still amazing to me for mid-December. And by the time the storms got here, they lost their strength, and we were pretty lucky here. So we're going to talk about this crazy U.S. weather. I'm going to kind of focus on winter wheat, the hard red winter wheat. It was amazing watching the storms roll across Kansas, Oklahoma, Texas, Colorado, and watching all the red on the wheat screen. Maybe Sterling can explain that to us a little bit, as that wheat was kind of getting blowed out, the prices were down. And we're also going to talk about the current 22 input issues. It looks like to me fertilizer and nitrogen prices have kind of leveled off a little bit, but they're still scary high. And we're going to talk about some of those situations moving forward. Slide here. I want to first talk about those tornadoes that came through December 10th and 11th. Pretty scary day here in central Illinois. That was another one of those mid-December days. I think Kay and I walked the puppy at 6:30 before dinner, and it was in the mid-60s again. We got pretty lucky here at Bloomington. We had a tornado warning, but most of the damage was further south than us. That day, I think there was 42 tornadoes. And that one in Kentucky was a really scary tornado. That was on the ground for 127 or 128 miles. Again, unusual weather. And as Sterling was talking yesterday, looking at the storms yesterday, the first recorded tornadoes in Minnesota, the weather data goes back to 1950, happened in Minnesota yesterday. So again, the weather is scary, and it's really been changing and changing pretty rapidly. What happened yesterday? Record temperatures, like Sterling said, most of Iowa also had record temperatures. They haven't compiled all the weather data yet, but I think it was the most widespread wind event that I can remember. Maybe Sterling can remember a day that had more wind. I don't remember a day anything close to that. And again, first ever Minnesota tornadoes. Again, that data went all the way back to 1950. Again, that's looking at the map. This is what it looked like when I woke up yesterday morning. All those dark browns are high wind warnings. The lighter browns are wind advisories like we had here in central Illinois. And probably the scariest are those red flag warnings that was coming through parts of, looks like New Mexico, through Texas into Oklahoma. And we also had a lot of fires in Kansas. So again, looking at geography of the United States, look at the pure acreage that was affected by these high winds. And thank goodness they came through in December. Number one crop we're worried about is, again, the hard red winter wheat. But again, a crazy weather day. And on the north side of that, we had a little snow. So again, really wild December weather here. I want to talk about the hard red winter wheat a little bit. Been doing this 30 years like Sterling. We always talk about how many lives winter wheat has, especially. We all learned last year that spring wheat maybe not quite has as many lives as we were thinking about. But there was a lot of talk that some of those very dry parts of the Texas, northern Texas, western Oklahoma, western Kansas, some of that wheat was blown out. And what was amazing to me watching these high winds roll through Kansas was, again, there's a little spot when the storm was going through Russell Airport in Kansas. The sustained wind was 60 miles an hour and gusts up to 100. Again, I don't know if I've ever seen a screen like that in my life. So again, weather has been really crazy here this December. And maybe Sterling can help me here a little bit. This is around noontime. I thought winter wheat was going to be up quite a bit. This is a hard red Kansas City wheat screen I took a snapshot of, and wheat was down 27 cents. I guess maybe the wheat, the wind is making the wheat tougher. So again, crazy to me, looking at the weather forecast and seeing what's going on in the weather. Again, like Sterling always says, this is a futures market, and somebody knows a lot more than me just kind of looking at the weather maps. Where's it's been raining goes back to Sterling's point a little bit. I've got the 60-day percent of normal map here. And again, we're going to talk quite a bit about the hard red winter wheat today, but look at all those reds. That's less than 10% of average moisture in the last 60 days. And that is concentrated in the southern plains and the western plains. And like the person from Ohio mentioned, pretty wet in Ohio, pretty wet in my part of Illinois, pretty good rains in parts of Iowa, Minnesota, and South Dakota. But overall, looking at that map, I can kind of see what Sterling's starting to see. That's a pretty dry map heading into December. And right now, normally, Minnesota, Dakotas, we've got snow on the ground. We're not having any evaporation. And what was the evaporation rates yesterday running through Kansas, Nebraska? Hard to know, but we lost a lot of moisture yesterday. So again, that's what the 60-day percent of normal precipitation maps as of yesterday morning. And we want to talk just a little bit about winter wheat ratings in the central and western plains. Now, they don't update these a lot here during the winter. The last rating in Texas was November 28th, but of the hard red winter wheat, 45% of their crop was poor to very poor, and that was before the last couple weeks of wind and dry weather. Colorado, 33% poor to very poor. Oklahoma, 16% poor to very poor. And Kansas had better rains, but they were 14% poor to very poor. And one thing I learned yesterday, maybe Sterling correct me if I'm wrong here, I was pretty worried about the impacts of the hard red winter wheat, but according to the world wheat picture, the Kansas City wheat's only 2% of the world supply. That's what I heard yesterday. So again, it's pretty big when you're worried about your own winter wheat. You're looking at the world picture. Like Sterling always says, it's a future market. Maybe not that big of a deal, though I do feel sorry for any growers who are affected by those wheat blowing out yesterday. Look at the drought monitor as of this morning. Last year, I don't think the drought monitor told the whole story. I was really worried about how dry it was in the Dakotas, Minnesota, and the Dakota crops were off significantly, especially the spring wheat that didn't have time to recover. But the Minnesota corn crop, according to the government anyway, came up with a 186. So again, pretty good performance despite the lack of rainfall. And looking at today's map, we'll talk a little bit more about that dry area winter wheat. We talked about that a lot, but I wanted to kind of talk about the eastern part of Iowa, northern Illinois, southern Wisconsin, parts of Minnesota. Most of the corn and soybeans are produced in the eastern parts of North and South Dakota, but still plenty of dry area there. We've also got some dry weather in Nebraska, parts of Kansas. So what that map is kind of telling me kind of loses what Sterling says. Long way to talk about drought, but we do have some pretty dry soils, and right now we still have evapotranspiration. It's going to be a little bit cooler here over the next 7 to 10 days. But there's still some pretty strange weather here for December, so we're having more evaporation than precipitation. Normally, once you put that snow cover across a big chunk of the Midwest, especially the northern belt, you're not going to have much evapotranspiration. And one thing, too, kind of looking at that hard red winter wheat area again, that area is probably going to get a lot redder here over the near future. Most of the rains are going to continue to be toward the east as we look forward in time. And looking at the week-to-week change kind of goes back to what I've been talking about. Most of the yellows where it got drier last week are showing up in the southern plains, Texas, Oklahoma, Kansas, Missouri, also parts of Nebraska. getting a little bit wetter in South Dakota. We've also got some dry weather coming here in Wisconsin. So again, Sterling always talks about it being a futures market. Maybe there's enough dry weather on the map, although the drought monitor fooled us a little bit. So it'll keep those traders kind of thinking that maybe we at least ought to be monitoring soil moisture as we watch our prices heading into springtime. Where's it going to rain over the next 7 to 10 days? Unfortunately, remember that I showed you the path of the tornadoes kind of from St. Louis down through southern Illinois, working their way through primarily Kentucky. Those four forks who are digging out from their rubble, we've got 2, 3, 4 inches of rain. So again, kind of going back to our typical winter in this weather pattern, most of the rains are going to kind of be coming up through the Ohio Valley, kind of up the Ohio River. Maybe some better rains for Arkansas, which has been pretty dry in eastern Oklahoma. We'll take that. But look at that big area that Sterling talked about. The white on the map is no rainfall in most of Iowa, Nebraska, Kansas, central and western Oklahoma, the dry panhandle of Texas, and also parts of Colorado and New Mexico, very dry over the next 7 to 10 days. And normally we don't worry so much about dry weather in December because it's cold outside, but it hasn't really been very cold outside. I want to talk just a little bit about Christmas travel. Looking at the maps, this is our 6 to 10 day outlook, which I think overall do a pretty good job. This shows us going up to Christmas Day. 6 to 10 day temperatures look very, very warm. And there's not a lot of precipitation. So it looks like to me, if you're going to be doing some traveling to many people are at, it looks like the only travel problems are probably going to be in the northern plains and maybe along and east of the Rockies. Here for us in central Illinois, I think I'm going to Indianapolis to run a race on Christmas Eve. It looks like I got a 50-degree day to run in Indianapolis on Christmas Eve. So very good travel weather for us here in most of the U.S. Looking out to New Year's, these maps don't take us to New Year's. They just take us to December 29th, but the pattern kind of looks the same. Very good travel weather east of the Rockies. Maybe any problems are going to be west of the Rockies and up there in the northern plains. So very good travel weather for us. But again, looking at the long-term weather maps, these maps also tell me we're probably going to have some additional soil drying. And again, going back, look 6 to 10 day, hard red winter wheat area, pretty dry, very warm, and the same in the 6 to 10. Just a few more slides here before I wrap up here today. I want to talk a little bit about fertility pricing. One thing we've noticed, well, I guess we'll start with, we've been very lucky here this year that we've had a very good fall. It started pretty rough with a wet October, but for the most part, the growers who wanted to get their fall fertility on, their P and their K and the nitrogen were able to get that nitrogen on where nitrogen is an agronomically accepted practice. And one thing I've noticed with the prices here in December, they have leveled off, but they haven't went down anywhere to this point. So again, prices are scary high. What's going to happen with spring prices? Maybe we'll let Sterling talk about that. My own personal thought is as long as corn and soybean prices stay pretty high, I know natural gas price has went down, but I really don't know if they're going to allow us to take advantage of a lot of that reduction in natural gas to show in the fertilizer price. So what are farmers doing? At least when I'm hearing, current prepaid fertility prices are pretty well at the highs. Seems like growers aren't buying much P and K at these prices, but some growers like my brother are getting pretty worried about having enough nitrogen to grow their corn, and more farmers are biting on these higher nitrogen prices. Some are, some aren't. And again, looking forward, is that high price going to be right or wrong? I know a lot of growers are looking for the comfort of having that 28% of that urea or that spring nitrogen bought and paid for. So again, time will tell on that. Any comments on that, Sterling, on the fertilizer prices moving forward?
Well, natural gas prices have collapsed. They've dropped. Oh, Christy, if you want to throw me the ball here real quick. As Christy does her best Patrick Mahomes imitation.
She's been passing better than Patrick lately. So.
Oh, my fantasy team needs help. I drafted Mahomes and Derrick Henry. I was in first place and pulling away.
Yep.
Mm-hmm. Now I need Patrick to light up the Chargers like nothing you've ever seen tonight just to make the playoffs.
Oh, thanks for reminding me, Sterling. I forgot there's a football game tonight. So
and remember, there's games on Saturday, too. So
thanks about that. I forgot that, too.
I need Patrick to have a banner night, and he needs to throw every one of those balls to Michael Pringle and to Darrell Williams. I mean, I'm running on reserves and super reserves, and it's I even have Adrian Peterson.
Oh my, that's a name from the past.
Yeah, utterly useless. But looking at natural gas prices here, how much they've really moved. And this is something we need to keep in mind. Commodity markets can be violent. And when we see these high prices, we need to remember that we need to take advantage of them, and that's why we hedge. But here you can see natural gas prices have dropped 42% from the highs. And yes, this is good for your home heating bill, although if it, the way the temperatures are here, I'm not too worried about that right now here. All the natural gas that's been brought in to make these end products, that was all bought back in here at these high prices. And the manufacturers are going to have to work that all the way through their system before they can extend lower prices, because you can't buy, natural gas 40% higher and then sell the nitrogen 40% lower. That just won't be happening. So it's going to be a very slow process. And two, commodity markets often bounce, and this one doesn't look like it's going to, and natural gas is a little bit different, but we can see some volatility in here, and that will slow anything that we see coming out on the retail end. Think about it like gasoline prices. We've seen gasoline prices drop noticeably on the board, and we've seen crude oil drop rather nicely, but it's going to take a long time for it to work its way at the pump. So coming this spring, we'll probably, as long as the natural gas behaves itself, probably looking at prices being a little bit lower, but we can't depend on that. And if they are lower, I would treat that as a bonus. So we want to talk about wheat. We can talk about wheat here. The first thing we're going to talk about here is the leader of the pack. Minneapolis wheat has been the most consistently strong wheat. Higher quality wheat. You can buy a little bit of this and blend it off with some of the other two to get to your milling standards. So that has kept this supported, and there's always a global hunger for good quality wheat, and when there's a problem with spring wheat, that tends to help everything else. The other thing that's supporting Minneapolis wheat is this. This is a speculative fund position. These are people buying the wheat on the idea it's going to go higher. And right now, that 1493, that was the record high. Right now, we're at about 12,444 long contracts. As you can see, most of the time, they're actually short this stuff. And the reason they own this is to make money. Now, if we go back here to this price, well, they've made money, but it doesn't look like they're going to keep making money. And if you work at a hedge fund, you've got a boss that's pecking on your shoulder every day, asking you how much money you made me today. And if we don't see prices start to take off again in here, those guys are going to be like, I'm going to book this, take some profits, and they'll start selling, and that'll send the price lower. And if we look at the other two here, let me get over to, you look at the Kansas City wheat, this looks like a top, this looks like a bear market. We peaked out, we made a record high, just like we did in the stock market a couple weeks ago. We traded, made a new record high, and finished the day lower. Whenever you see a market do that, that's a pretty good sign. The party may not be over, but someone's coming for your cake. And as you can see, prices have fallen off, and they look to they're doing a little bit better today. But generally speaking, if we can't get back above $8 a bushel, we're going to have a problem here. And the same story going on in Chicago, only it's even worse. In that, again, we had that same bad price action right here. The market's now falling down below the 100-day moving average, which means funds are getting short this, they're selling it, and that is going to pressure prices. And we're going to need several chunks of good news to get these prices moving back higher. And eventually, the idea will be, well, I can make more money if it's going down, and we'll see funds start selling this aggressively. And that's where you might push prices back, down here into the lower area. And if we look at historical norms for March wheat, we're going to go ahead and look at March wheat and the average price going back, and we'll take this back to 2016 over the last 5 years. Average price is $5.52. We're at $7.68. So there's room for this to go down. Wheat prices have generally, we've trended a little bit better, but a lot of some of this is supply chain issues. And again, we had that pronounced drought in western Minnesota and the Dakotas last year that really helped boost spring wheat, and that drug everything else along with it. Wheat is very much a global market, so Ideas for European production have been improving, and I'm going to punch up. This is a new feature with this, Christy. It wants to get in my way. These are the Paris milling wheat prices. So these prices often lead the world. As you can see, we got up well over 300 euros a ton. And these prices have also fallen back, although today saw a drop. Market opened strong, fell apart, finished strong. This is a sign that maybe, just maybe, we might see a little bit of a bottom and we might get a little bit of a bounce here. But again, this market is going to need some news to help push it higher. Also, we're at the end of the year, and those funds I talked about, they want to book their profits because there's guys looking for bonuses because they want to buy a new Ferrari. So, you know, they're not going to be shy about taking and putting money in the bank here.
Sterling, we've had a couple questions come in, not about wheat.
Okay.
So one came in a few minutes ago, right before, actually while we were passing the ball to Mike. So this was with prices for soybean and corn at good levels, how much of the 2022 crop would you recommend a producer sell at this point, if any?
I would recommend at least putting on an initial hedge that would run from 7 to 12% of your production. And I would look to do a hedge that allows for some upside. So what that means is if you just sell futures, you've sold your crop and you've locked it in. And that isn't the worst idea I've heard. But what I would do with that, if I did that, is I would buy some sort of call option, a near-dated call option to lay off some of that risk and leave room for some upside in there if we have problems coming into the spring. The other thing that I would look at doing is some sort of put spread, again, on about 7 to 12% of your production, depending on how much you think you're going to grow and how many acres you're actually going to be planting. And I would get that done right now. The other concern that I have that may be particularly a problem for soybeans, I haven't materially seen this with anybody I'm talking to here in Nebraska, but I have friends up in Michigan. Some places are talking about having trouble getting fertilizer and things of that sort. If we see that, two big concerns. Number one, you will be switching to soybeans and not planting as much corn. You won't be doing corn on corn. You will be planting beans. And that will create more bean acres. Two, there may be some people who, instead of planting wheat, they may plant soybeans. So we could see soybean acres being a little bit stronger. That's your first bearish concern. So that is one concern. On the other hand, if we see fewer inputs go in, we're going to be much more dependent on getting weather that's perfect. Well, our weather right now is nowhere near perfect or even remotely normal. So if we see fewer fertilizers and things go into the ground, that means production can be lower, and that is the bullish side. So we have a somewhat ambivalent picture. That's why I want to make sure if you lock something up to lock up the downside, let's not say goodbye to the upside just yet.
Mike is nodding his head, so he must be.
Agreed. Yeah, I forgot to mention, Christy, one thing we need to watch too, like Sterling alluded to, we're having a lot of trouble getting some of our herbicides, especially some of the older ones like glyphosate or the Liberty components. A lot of talk is that they're not making as much active ingredient in China right now, or they're cleaning up their atmosphere because of the Olympics. And all those things could input production if you can't get some of your most basic herbicides. So again, some farmers have cut down on their P&K, going to live off the soil. We've got to get the nitrogen thing figured out, and herbicides could be an issue too. So like Sterling says, there's a lot of uncertainty moving into the 2022 crop.
Yeah, if I had 12 inches of snow cover out here and we were looking like we were going to see a normal winter in terms of precipitation, I'd feel a little bit differently. Second concern is our move back to the average, and it all shows up around here at once. And we have a replay of what we saw, with Waterworld a couple of years ago. That's no good too, and especially with input costs being and having to replant, that's another problem. That's why I don't want to say goodbye to the upside just yet, but we need to be prepared for things being normal, and we can't hope that we're going to have some weather problems to help drive prices.
Yep. We said this for years. Hope is not a plan. You really just have to have a plan. We have one more comment that leads into a question. So there is coming to Grand Forks, North Dakota. This is from one of our agents up there. A 25 million bushel per year corn milling facility that's going to be coming to Grand Forks, North Dakota. This will affect our overall corn use.
Christy, I can't hear you.
Yeah,
You can't hear me?
now you're back.
Now you're back.
Sorry about that. Okay, so one of our agents up in actually is up in the northeast part of North Dakota. There is a new corn milling facility that's coming to Grand Forks. It's a 25 million bushel per year facility. And he wants to know, his question is how much we think this will affect our overall corn usage.
For overall corn usage, it probably will not move the needle that much. But for you locally, this is a good thing. Because when we look at price, we look, when I put up these Board of Trade prices, these are the prices for the world. Local prices deviate from that. A new facility, kind of like the big chicken plant they built out here, means new fresh demand. That means you can think about maybe seeing some better basis levels and that improving. Because when we talk about hedging, there's two things we talk about. We talk about board risk, which is, what hits the news. Your other risk, which is just as important to pay attention to, and this is something, if we need to talk about on a localized level, you can get Brooks and I together and Mike, and we're happy to talk to you about it, is how does your basis perform? Because it doesn't help if the board rallies $1 and your basis doesn't go up. You're basically stuck. So this is something that should improve basis, improve competition, and that's something that's going to be good for those local farmers.
Thank you. I think that was great. So we just had another question come in. Care to elaborate on fertilizer prices and availability? What are your thoughts?
Mike, you want to take a stab at this?
I guess I'll go first, Sterling, and you follow up when I get done, I think, Sterling. My own personal thoughts are, I don't think P&K will be a problem. A lot of farmers are going to kind of hold off on that. And most of the P&K that was applied at lower pre-book prices. So I don't know if P&K will be a big issue as far as availability. I think if the prices stay high into spring, most farmers will just kind of punt on that if they haven't applied already. Nitrogen is a tougher one. I think Sterling did a nice job with his charts. He said, although natural gas prices are going down, most of the fertilizer suppliers bought it when it was high. So I think we have to burn through the inventory. My own previous experience as a retail fertilizer guy many years ago and watching it as a seed agronomist, once retailers are stuck with high-priced inventories, they sure don't want to give it away, and it takes forever to run through the inventory. So my own personal thoughts are I think prices stay high through spring, even though natural prices are low. And I think we do have some potential values, potentially, maybe for side dress. But again, we'll let Sterling throw his 2 cents at this too. But I think prices are going to stay high because the retailers are locked into some higher prices, and they sure don't want to buy high and sell low.
Yeah, again, you might see maybe some localized improvements here and there. But generally speaking, until we work through those supplies, don't expect prices to go lower. As far as availability, that's going to be a localized thing. Eventually, it may get to the national news and we hear about these problems, but that national news is just a summary of what happens in every town. So pay attention, be working with your suppliers to make sure you can get it. And, you probably want to be first in line, particularly for nitrogen, if we start seeing areas where it starts to ration.
Yeah, Sterling's right. We can't grow corn without nitrogen. That would be my number one concern. And that is why some farmers are biting at these higher prices, just to get something locked in and to feel a little better sleeping at night. P&K, we can wait on that on most situations.
I'm not seeing any more questions that have come into the chat. So while if you guys have any, go ahead and put those in. But while I'm waiting to see if any others come in, I want to remind you all that we do have a couple meetings coming up in January. So we have our regular monthly meeting that's just like this, and that will be on January 20th. But then we also have another big meeting that is coming January 12th. And I am going to ask Sterling to kind of talk a little bit about that. That is January 12th again. That is the WASD, but we also kind of call that the big one.
Yes,
So
the
want to share a little bit?
For those of you who are on for our December report, I don't have to tell you that it was largely a big nothing sandwich. There wasn't, well, for corn and beans, it was truly a nothing sandwich. They didn't change anything. And the January report is the last time they touch anything on acreage or production, generally speaking. They will also be dealing with, how exports look, and we'll be kind of past China's buying period there. Also, from a global point of view, we'll have a lot more confidence about what we're seeing out of Brazil and Argentina. We'll also be a little further on with the COVID story. So seeing these docile prices here and not seeing a lot of aggressive behavior in corn and soybeans, that would tend to tell me that the January report is probably going to be a big report. And this is something, this will start setting the tone for what we're going to be seeing when we get the May report and we take our first look at what's going to be going on with the new crop that we're going to be planting here soon. So make sure you are tuned in for that January WASD report, because we also get an ending stocks report that day. That should prove to make up for the December report, which was kind of a vacation for the USDA.
So I'm not seeing any other questions, and we've had you on for about an hour. Thought this would be a really quick meeting, and obviously we are never very good at thinking what we know the time's going to go. So you
and Christy, I have one other thing that I want to talk about, and they're probably not going to like this. This is a chart of January crude oil, and we were talking about, big plunges. We're talking about things that kind of look like bottoms. See a price that goes down like this. Market opens, spikes to a new low, comes back up, then trades out of the hole. That's a sign of a bottom. I'm not saying crude oil's done going down. There's lots of things that can make it go down. But I just saw an analyst who I know who, well, I'm going to be nice here. Generally speaking, if he does something, you want to do the opposite in a hurry with size. And he just came out and said that crude oil was going to $44 a barrel. So that tells me that maybe we may see crude oil prices wake back up, because one thing, the people who produce this stuff, if it starts getting cheap, they quit producing it because it costs nothing to keep crude oil stored in the ground. And it's very easy to dial that production back. And they may be willing to do this, particularly if we start to see prices consistently above $73, $74 a barrel. We can make up a lot of these losses, and if we get back up above 77, it'll be like this drop never really happened. So,
yeah, well, thanks. Merry Christmas there, right?
fill up your cars now.
Exactly. Fill up. I'm going to say that unless maybe you're in Illinois, but that's okay. But we do want to wish you all a very, very Merry Christmas and a Happy New Year. And we want to thank you all for choosing AgriSampo North America and choosing to work with us with the Edge Group. We really appreciate your support and want to be here to help you. So if you have any questions, or if there's anything we can do to help you and be that edge for your marketing plan, let us know. We are at marketinginfo.international.com. We're happy to help answer those questions, work with you and your producers so that you can have that edge with your plan and have a really strong 2020 year. Thank you so much. Have a great new year.